Okay, in the previous class we discussed about the bond pricing and as well as the bond price volatility and which are the factors which affect the bond price volatility. That means what we can say that now we are very much sure that the bond pricing or the return from the bond basically fluctuated because of change in interest rates, and also there are certain other factors like term to maturity or the coupons etc. And looking into these things, whenever we discuss certain concepts like duration, convexity etc., we can say that how these particular concepts or the concept of duration, convexity etc., will be helpful for managing the bond portfolio. And also it also should know that how this bond portfolio strategy basically worked out by the investor in the market. So, today we will be discussing about bond portfolio strategy. That means how these investors or the fund managers manage the bond portfolio in the market to maximize the return. In this context, if you observe here, there are different types of strategies this portfolio manager uses. One is your passive strategy. It is just like the equity portfolio management what we discussed in the previous sessions. And also we have we name it semi active management strategy, but it is basically this matching strategy, later on we will see. And third one is the active management strategy, where the bond portfolio manager or the investor is actively involved in managing the bond portfolio in the market. So, today we will be discussing about the first two, which talks about the passive bond portfolio management strategy and the semi active management strategy. So, first let us see what exactly the passive strategy means. Whenever the investor uses the passive strategy, the passive strategy is basically nothing but it is here the investor has no expectations, because this change in interest rates basically the expectation of the investor should change. But here whenever the investor basically talks about the passive strategy, he is not bothered about the expectations level or how the movement of the interest rate is happening in the market in a particular point of time. So, the key inputs and basically what it happens that before this investment takes place or before the investor basically decides that where he should invest, his objective is very much known, that whatever return he wanted to get or how basically his objective can be maximized and which kind of bond can fulfill the requirement of the investor. Therefore, what you can say, the key inputs are known at the time of investment analysis. So, therefore, if from the beginning it is very much clear that which are the things the investor is trying to take into account in the bond investment. So, then the role of the expectations are basically little bit less. So, here we have basically used two types of strategy which comes under the passive strategy of the bond portfolio. One is your buy and hold strategy, and second one is your basically indexing strategy. So, these are the two major strategies used by the fund manager or used by the investor whenever they manage the bonds passively. So, what exactly this passive strategy means, or within this passive strategy what is exactly how it is defined, this buy and hold strategy. In the buy and hold strategy, a manager basically selects a portfolio of bonds based on the objective and constraints of the client with the intent of holding these bonds to maturity. That means, if for example, you say that certain people or certain investors in the market, they are very much sure whatever amount of the return they or whatever amount of the yield or whatever amount of the liability they will have in the future. Let for an investor wants 10 lakhs rupees after 5 years. So, he should invest in such a bond where he can get at least 5 lakh rupees or more than that from the bond investment. So, his objective is very much clear. So, that is why what he should do or what basically he does, he buys a bond which can fetch at least 5 lakhs rupees after 5 years. So, from the beginning his objective is defined, that how much return he wants and what is the exact amount of the liability he will have. So, therefore, what basically he does, he takes the position in the market today in such a way that or he should decide a bond portfolio in such a way which can fetch at least 5 lakh rupees in the end of the 5 years. So, therefore, the role of the expectation in that case it will be less, and it is assumed or it is always intended that this particular client or the investor holds the bond up to the maturity, because he has decided this particular maturity period from the beginning with certain objectives. Another thing is the investors do not trade actively to maximize the return. Already what I told, that you see that the investor does not take any kind of expectations level into the consideration, and once the expectation level is not taken into consideration, then they do not have to change the position frequently in the market, and they do not have to trade in the market actively to maximize the return, because their liability or their requirement is already fixed. So, to get that fixed amount of the requirement, they basically invest in a bond or invest in a portfolio of the bond in such a way the total return of this particular bond can be maximized. So, therefore, there is no need to take the position actively in the market to maximize the return. So, what these investors basically do here, they hold the bond with a maturity or the duration close to their investment horizon. In the beginning what I told, let you need 5 lakh rupees after 5 years. So, what basically he does, he decides a bond, he decides the bond where the term to maturity is 5 years or a duration will be 5 years, and accordingly if you will take the position in the market, then this 5 lakh rupees investment or 5 lakhs rupees requirement what he wants from the market in a span of the 5 years can be realized. So, therefore, what we can say, that always the investor has this privilege or investor has the opinion that he should buy the bond and hold it up to a certain period, and that certain period is basically term to maturity or the duration, and that means the investment horizon period of this particular investor on the basis of the requirement should match with the this bonds term to maturity or the duration in that particular time. Another characteristics in the buy and hold strategy, if you see that the major risk what these investors want to eliminate from this is price risk. What do you mean by the price risk? Is basically whenever you know that this price of a bond or the price fluctuation of a bond is basically determined by the interest rate and the other variables. But what basically they see that our main concern is basically due to the interest rate the price changes. So, that means whenever the price change we are exposed to price risk. So, if there is a price change we are exposed to the price risk. So, the basic objective of the investor is to minimize the price risk. So, here what happens, that investor takes the position in such a way that which can fetch 5 lakh rupees after 5 years, but he is also exposed to price risk, because this interest rate in the market may change on the basis of the certain factors which basically is not observed by the investor from the beginning. That is why this exposure to price risk or the fluctuation of the price which basically increases the price risk, that should be eliminated on the basis of the objective of the investor. So, therefore, the basic objective of the investor who follows this concept of buy and hold strategy is to eliminate the price risk. And another observations, if you see that, or another characteristics of the buy and hold strategy, that is the return on security. A return on security is controlled by coupon payments and reinvestment rates. That means, if you observe that how this return can be achieved from the bond, return from the bond. What this investor does here, he has two things, one is your cash flow, the regular cash flow, which is nothing but your coupon, and another thing he gets the reinvestment return what he gets from the investment from the investing the coupon payments. So, here what we have seen that return on security is totally driven by the coupon payments and as well as the reinvestment rate or reinvestment of the coupons in the market at a certain period. That means, whenever the investor is waiting for this particular bond should be realized after the term to maturity. So, this intermediary cash flows what he gets in terms of the coupon payments, and again the coupon payments are again reinvested in the market. So, these are the two components what the investor always expect to get in the interim period to maximize the return, to maximize the return. So, the return from the security comes from these two sources. Then another who basically uses this philosophy or who basically uses this strategy in the market. As we discuss here, it is more suitable for income maximizing investors with low level of the risk. Basically, you will find certain investor where they do not want high return, but at least their income should be protected or the income should be maximized for a certain period of time, and they do not want to take more risk to maximize their income. So, who are those? If you observe here, it is more applicable for the pensioners, endowment funds, bond mutual funds and insurance companies, where if you observe that the pensioners always wants to play the safe game, they always want to take less risk and they want to maximize the return at a particular time. Then another way if you observe, we have this particular insurance companies, and their liability is very much unknown from the beginning. So, that is why they want to play the safe game, and even if they know that how much liability they will have using a probabilistic function. So, that is why they should go for a strategy like buy and hold, which can fetch them the certain amount which they required after certain years. So, like that the particular agencies or particular persons who are basically the believer of the philosophy of income maximization, they basically always use this buy and hold strategy to maximize their income in the market. Within this, that means here what we have seen that the investors should hold a bond, the investors should hold a bond if their investment horizon period is 5 years, then he should hold a bond where the term to maturity is 5 years. And after 5 years, he is expecting he will get a return of 5 lakhs. He will get a return of 5 lakhs. So, here what we have observed that from the beginning we are only concentrating on certain securities where it is the term to maturity is perfectly matching with the investment horizon period of this particular bond holder, and as well as the certain amount of the liability what he is expecting after 5 years, that is materialized. But what we have seen sometimes this because of the interest rate fluctuations, because of certain other macroeconomic variables, this exact amount of the liability cannot be realized after certain amount of the years. If this exact amount of the liability cannot be realized or there is a fluctuation of this particular interest rate, there is another way of this buy and hold strategy some of the investors use, that is called the bond laddering. What do we mean by this bond laddering? In this bond laddering case, already I told you that it is another form of buy and hold strategy, but instead of using only one term to maturity and all the money should be spent in one term to maturity period bond, it involves the investment in bonds with several maturity dates instead of a single time horizon. That means, if your investment horizon period is let 10 years, then certain amount of the money should be kept where the term to maturity or invested should be invested on bonds where the term to maturity is 3 years, certain amount of the bond should be 6 years and final certain amount should be 10 years. And what is this philosophy? Why basically the investor should do that? The investor basically should do that because by staggering the maturities of the securities, the investor is assured that money will be available for reinvestment at regular intervals. That means, what you have observed, for example, they said this interest rate has gone down, the price of the bond will go up, but here he will get some more return, but after certain time they will realize the 6 years interest rate has gone up like anything. Then what will happen, that this price risk will increase. So, in that case, the return what they have realized here, extra return, that can be neutralized here. But if all the bonds will be 10 years maturity, then what happens? If there is a fluctuation between the interim periods in terms of the interest rates, then the exact amount of the liability may not be materialized after the 10 years period. Another thing also, the investor is also assured certain amount of regular income they will have, or certain amount of the money they will have in the span of 3 years and 6 years, which can be reinvested on the basis of the investor's objective. So, already I told you that once this there is increase and decrease of the interest rate can be offset to each other within this interim period, it helps offsetting the interest rate risk. It helps offsetting the interest rate risk, because of change in interest rates, when the price level or the price of the bond changes, then we are more exposure to the price risk or the other type of risk. But once we have the different position in the market on the basis of the different term to maturity, the interest rate risk can be reduced or it can be offset by taking the different position on the basis of the term to maturity. And it also follows the philosophy of diversification. What do you mean by the philosophy of diversification? We have the bonds not only on the basis of the different characteristics in terms of the other category, like in the beginning case what we have seen, that there is no such kind of diversification. We are holding the bond where the term to maturity and other things or coupons and etc. are same throughout the period to materialize or to get certain amount of the return after certain years, which can perfectly match to our requirements. But here what basically we do? We basically take the position in such a way, we have the different bonds in our portfolio on the basis of their term to maturity. So, that is why the diversification can be taken place, and this diversification basically helps to reduce the interest rate risk. Diversification helps to reduce the interest rate risk in the market. So, that is the way basically the bond laddering strategy works in the market. Then another type of strategy we have that is called the indexing strategy. What do you mean by this indexing strategy? The basic objective is to construct a portfolio of bonds that will equal the performance of a specified bond index. You go back to the previous session whenever we discussed about the indexing strategy in terms of equity portfolio management. It is the same philosophy what is used in the bond portfolio. Here there what we are doing, we are replicating one equity index, and what we have observed there, that the portfolio manager or the investor always wants to get the maximum return what this particular index is giving. So, therefore, what we can say, that in that case we are replicating one particular index which is our benchmark index, and the return what this benchmark index is giving, this much return we are trying to get from the market at a particular time period. In this case also, in the bond portfolio strategy case, we are following the same strategy, same philosophy. How it works? Basically, we are again replicating or we are again targeting a particular bond where this the portfolio should give the as much as return what this particular benchmark index is giving. And performance of this particular index is measured in terms of total return realized over the investment horizon. What is the total return this index is giving, and what is the total return this particular bond portfolio with what has been constructed on the basis of or by replicating this particular index, that has been compared, and accordingly we can say how this particular index is performing. And what are those different advantages of indexing strategy? Sometimes even if we actively trade in the market or we take the different position in the market, sometimes this there is an inconsistent performance of the bond manager, portfolio manager. It is because of some of the macroeconomic factors, or sometimes also the individual manager's performance, and also it involves very high transaction cost. But in the indexing strategy we can minimize that thing, because we do not have to change the position frequently. And the degree of control exercised by the investor, that means in the active case the fund manager, or we can say that or any other case, the particular manager takes his own decision to change the portfolio construction, the asset allocation in the particular bond portfolio. But here some control has been given to this investor also. He can decide that how this particular portfolio allocation can be made on the basis of his requirement, by which the return or the yield of this particular bond portfolio can be maximized. Therefore, there are certain advantages involved in this. So, what is the basic objective of this? The basic objective of this thing is that to minimize the errors what we can get from this particular return expectations, and as well as the maximization of the income. So, which are the factors? So, whenever we talk about the index, benchmark index, or we can say that we construct our own index by looking into a benchmark index, which are the factors which basically play the significant role for selection of the index, or how the index can be prepared. Here the major factor is investors risk tolerance. That means, if investors risk tolerance level is very low, that means we can make an index by taking only the government securities, or we can say that government bonds which are issued by the, or government securities which are issued by the government. That means, they have a very risk tolerance limit is very low. But if we have the risk tolerance limit is little bit high, then what we can do? We can go for some risky corporate bonds to make our portfolio, or we can make our index, and accordingly the benchmark index can be changed. The benchmark index can be changed, because the investment philosophy in these two cases are different. And another factor we have is objectives. What do you mean by the objectives? The objective basically talks about that what this investor wants. What this investor wants in the sense, whether the investor really wants to maximize the income in that case, or they want to get certain amount of, they want to hedge their certain amount of the risk because of change in the interest rate in the market. Therefore, from the beginning, if it is clear what is the basic objective of the investor, what he is trying to do, then what happens, that we should take the position in such a way by which the certain objectives can be fulfilled. Then also obviously we will have always this constraints imposed by the regulator, because we have certain regulations on which we can say that certain portfolio you can should not consist of more than this type of bond or that type of bond, and some bonds are basically tax free, some bonds are not tax free. So, those factors will be taken into consideration because of the constraints imposed by the regulators. So, these are also the another factor, this is also another factor which basically affects the construction of the index whenever we follow this indexing strategy. And how basically this indexing methodology works? How this indexing methodology works? Already I told you that the basic objective is the tracking error. The basic objective is the minimizing the tracking error. What do you mean by this tracking error? Already you know, it is basically the minimization of the variance of the fluctuation of the returns between this particular index and the benchmark index. Let your R1 is a return from the benchmark, RB return from the benchmark index, and let your RA, which is the return from your actual index, return from your index. Then if you calculate this variance of this return, that means you have RA minus RB, we have the fluctuation on the basis of the different periods, let this is x, then this variance of x, or if you take the root of this, it will be the standard deviation of the x, basically the tracking error. Already we have explained this thing thoroughly in your equity return case. In the same way also, this basically this particular function works, that always the basic objective of the particular investor who follows this indexing strategy to minimize the tracking error. So, always they try to minimize the tracking error. Then why this tracking error basically comes? What is the different causes of the tracking error? Tracking error causes is occurred because of transaction cost whenever we measure the construction of index, which may not be available to the benchmark. Differences in the composition of the indexed portfolio and the index itself. Sometimes already we know that there is another way we can change the composition. We can also take a very customized index instead of only indexing the same way, whatever way the index actual benchmark index has been prepared. So, in that case what happens that it also affects the return of this particular portfolio, by which the tracking error also increases or tracking error may decreases, and that is why there is a change in the return between the benchmark portfolio and the actual portfolio what you have constructed. Then we have also the discrepancies between the prices used by the organization constructing the index and the transaction prices paid by the index manager. So, if that particular difference is there, that also affects the tracking. That means, in overall we can say that transaction costs or the adjustment cost, which basically play the significant role for the tracking error in this case. And another way is the portfolio allocation, whatever allocation has been given to this particular benchmark portfolio, this same allocation may not be maintained in terms of the index what we are preparing or what the investor prepares himself, and because of that the tracking error comes into the picture. Then already like your equity indexing portfolio, we have the same methods always we follow, that methods of the construction of the portfolio to replicate the index. We have a stratified sampling approach, we have a or the cellular approach, then we have another approach we called it optimization approach, then another thing is the variance minimization approach. And what I told, this is the optimization approach or the variance minimization approach is more or less same. Here we are optimizing the return, second case we are minimizing the variance or the risk what we are facing from this. What exactly this cellular approach means, if you talk about, then if you observe here, the cellular approach means your index, let you have the different cells you can construct. On the basis of that, there are certain category what you can observe, that what basically this certain categories basically consist of. Let you are preparing index, you have taken certain, let industry is one of the category on which you are preparing this. Number 2, your term to maturity. So, you have the different cells you can make. Let industry, there are 5 industries available, there are 5 cells, and term to maturity, let we have the 3 alternatives available, there are 3 cells. So, on the basis of that, the number of cells will increase, and your construction of the index should based on this, and you can decide the number of bonds from the each category in the stratified way. So, that is why we call it, we are using the stratified sampling approach to construct this particular index in a particular time period. Then optimization approach, already I told you that we have certain objectives and we have certain constants. Then either you want to minimize this particular return what or income what you are going to get from this particular index, or you want to maximize or you want to maximize the return what you want to get, or you want to minimize the risk or the variance what you are observing between this benchmark portfolio or the actual portfolio what you have constructed. So, these are the different ways this particular construction of this particular portfolio is made or the index has been made. Then we have another type of strategy what we call it semi active management strategy, what we name it. Different books have used a different connotation for this, but here what basically the semi active management strategy means, there are basically 2-3 approaches we use here. One is your dedication or the cash matching strategy, one is your dedication or we call it the pure cash matching strategy. In this case what basically happens that or what exactly whatever way it is defined, that dedication refers to bond portfolio management technique that are used to service a prescribed set of liabilities, and basically it is the most conservative strategy. Most conservative strategy. What basically how it works? You just observe here. For example, we are you take already I can tell you that the best instrument of following this dedication strategy is zero coupon bonds. Zero coupon bonds. So, what happens in zero coupon bond? Suppose a liability of a particular investor has been given for 10 years. Let the liability of the investor for the 10 years has been given. So, this is your year, this is your liability, this is your maturity value, this is your let current purchase price, and this is your let current annual yield to maturity in the percentage. So, what basically how this particular function works? If you observe here that if you are investing only on the zero coupon bonds which has no regular flow of income like your coupon payments, how this dedication strategy basically works? That means perfectly your income or the after certain years will be perfectly matched to the liability. That is basically the perfect matching with liability with its assets, that basically here we can talk about. This is your 5 lakhs is your liability after 1 year, this is let 10 lakhs, 15 lakh, this is 20 lakh, this is 25 lakh, 30 lakh, then you have 35 lakh, 40 lakhs, 45 lakhs and 50 lakhs. This is the case, then maturity value already you know after 1 year this is the same amount, it is same like your liability, like your 5, 10, 15, 20, 25, 30, 35, 40, 45, 50 because this is a zero coupon bond. Then what should be the current purchase price? Then in this case you should let he can either at the end of the 1 year he requires 5 lakh rupees after end, if he wants 5 lakh rupees after end of the 1 year, then how much he should invest now? Let your current yield is 8%, if is 8% of 1 year maturity bond, then he should invest how much? He should invest 4,62,963 rupees to get this 5 lakh rupees after 1 year and to meet the liability whatever he would have. Then in this way what generally the individual can do, the individual can finance the liability stream by investing in the zero coupon bonds. The current yield to maturity basically, and the required current investment are basically nothing but they basically on the basis of the current yield to maturity, he basically invests certain money in the market in certain period. Let your current yield to maturity in the second period will be 8.5%. So, like that he should invest 8,49,455 rupees to get this 10 lakh rupees after 2 years, what he should invest in the beginning. So, like that if you see that the zero coupon bonds are basically redeemed at the same time when the liability falls due. So, finally, whenever he will invest, let your yield will be 11.5%, but here he should invest 16 lakh 83,532 from the beginning current period, and after 10 years if the yield to maturity will be 11.5%, then perfectly it will be matched to this 50 lakh rupees whatever the liability this particular investor has. So, therefore, here there is no regular income flow whatever we are expecting from a bond, and all the money should be invested in the zero coupon bond which will be redeemed at the par, and exactly amount of the liability whatever he will have, he will be getting it in the end of the period. Then we have another way also, we have dedication with reinvestment. That means, we can also assume that there is a regular flow of income, that means there is coupon involved that. Then how this particular strategy works. Let if I tell you that cash matching with reinvestment, we name it cash matching with reinvestment or a dedication with reinvestment, whatever name you can tell. Reinvestment opportunities are available here. Let the particular pension fund, if you take the example of a pension fund, the following liabilities they will have for the next 10 years. Let this is your year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is your years, this is your liability, this is your liability. Then what we have observed that let the liability of this particular pension fund in this 10 years is, let this is 10 lakhs, it is in terms of lakh. This is let again for second year it is again 10 lakhs, this is 15, this is 20, this is 25, this is 30, this is 35, 40, then this is 45, and let this is 50. This is the way this particular liability of the fund manager will have. Let for the simplicity we can assume that all the bonds are currently trading at the their face values, and therefore, the YTM is equal to the coupon rate. Trading at YTM is equal to your coupon, because they are traded at their face value in that particular time period. So, let if you observe that we have certain bonds which are available to him, and here the term to maturity, let the company like let this is your company which basically issues the bond. Credit rating is same for all the companies. This is your term to maturity, and this is your face value, and this is your coupon. Okay. This is your annual coupon rate. Then let this is your company A, B, C, D, E, F, G, H, I, J. This is your different companies. Then we have term to maturity 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then we have the face values of this particular bond at 100 rupees. This is 100 rupees, 100 rupees, 100 rupees. Let this is 1000. This is also 1000. This is 100 rupees. This is 1000. This is 1000. This is also 1000. And coupon we have taken annual coupon rate, annual So, this is let 8%, this is 8.5, this is 9, 9.5, this is 10, let 10.5, this is 10.75, let this is 11, this is 11.25, then this is 11.5. These are the different coupons are available. Let what the fund manager had assumed that they would like to invest in the bonds where the YTM is not less than 9%. That means, he wants to decide that he will invest from the C, because this is your threshold limit where he has decided he will invest only the bonds where at least this yield to maturity will be 9%. Then how this particular matching can be taken place in this case? If you observe here, then what basically they have done, let they have invested certain money that in this particular bonds, let company, now they have chosen this company, they according to their rule they have chosen the company C, D, E, F, G, H, I, J. This is the company what they have chosen, and the investment what they have made. Their company C, they have invested 5 lakh, like that they have invested 7 lakh here, they have 11 lakh in the E, 15 lakh in the F, then 22 lakh in G, 25 lakh in H, 30 lakhs in I, then 32 lakhs in J. So, this is the way this they have invested this particular bond. Now, our objective is what basically we have to see that exactly this liability and asset after certain years should be perfectly matched. There should not be any surplus in the end of the period, or there should not be any kind of deficit in the end of the period according to our hypothesis what we were talking about. By looking into using this data, if you observe, then what is the liability is already given to you. That means, you have the year, let this is your year, this is your liability, this is your cash balance at the beginning, cash balance at the beginning, then interest rate, interest earned on cash balance, then your coupon received, then you have redemption, you have the redemption, then you have the total cash available with you, then you have the surplus or the deficit in the end. If this is the way you want to study this particular bonds, then we can see that how this particular matching is taking place. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Already you know that what is the liability we will have for the different years on the basis of the term to maturity. Okay. So, if already this thing is given to us, then we have to measure this, how this works. Let already you have known this is 10 lakhs, all are in lakhs. Lakhs. Okay. So, already we can assume that how this particular thing works. Let another certain assumptions we can take. The reinvestment rate we can assume the reinvestment is let 5%, interest available for is always the 5% on the basis of this investment. Redemption is basically nothing but the reinvestment rate is 5%. The redemption is the maturity value of the investment. Then the total cash available for a year is the sum of the cash balance at the beginning plus the interest earned plus the coupon payments whatever they have and the redemptions. Surplus in the end is basically the cash available for the year less the liabilities of the particular year. This is the assumption what we have taken. This is 10 lakh, this is 10 lakhs, this is 15, this is 20, this is 25, this is 30, this is 35, this is 40, this is 45, this is 50. Then cash balance on the beginning in the first year, there is nothing available. Then your interest earned is nothing. Then coupon is you have to calculate the coupon in the first year. The coupon in the end of the first year you can calculate, that is your you have invested this 5 lakhs in C bond, that is why the 5 lakhs multiplied by your 0.09 plus your 7 lakhs multiplied by 0.095 plus 11 lakhs multiplied by 0.10 plus 15 lakhs multiplied by 0.105 plus 22 lakh multiplied by 0.1075 plus 25 lakh multiplied by 0.11 plus 30 lakhs basically 30 lakhs multiplied by 0.1125 plus 32 lakhs multiplied by 0.115, that will give you 15 lakh 96,000. So, the first year this coupon received will be 15 lakh 96,000 and that will be your coupon payment received. Redemption is nothing. Total cash available is also the 15 lakh 96,000. Surplus is this minus this, basically that will be 5 lakh 96,000. Anyway, total figure we can write, there is no need to write lakhs here. Okay. 5 lakh 96,000. Then in the second year you will have cash at the beginning is 5 lakh 96,000. Then you will have this interest earned in this multiplied by 0.05, this will have 29,800. Then coupon payment received is same, no redemption 96,000, no redemption, that is why it is 0. Then this total value this plus this plus this will be 22,21,800 and the value will be this minus this, that will be 12,21,800. Will be 12,21,800. Okay. So, then what you can do, we can after 3 years you have now your cash balance at the beginning is 12,21,800, interest this multiplied by 0.05, that will give you 61,090. Coupon payment received is 15 lakh 96,000. Then redemption is basically after term to maturity is company C, they have invested 5 lakhs, the term to maturity 3 years. So, now they have redemption value is 5 lakh, redemption value is 5 lakh. So, that will be 33,780 890, and then okay, 990, then we have 1878890. Like that, if you see that again this will be used as 1878890, then we have the 93945, then 155100, then we have 7 lakhs again redemption, then we have here the 42,23835, then we have here 22,23835. If you go on in the end, you will find this this particular surplus value will come 394, will be approximately equal to 0, what we can make. So, therefore, if you go on increasing these things, so like that if you observe here, the liability of the 50 lakhs will be perfectly matching with this amount will come, this 50 lakh 394. So, therefore, what we can say that the basic objective of the investor always to match with this value with this value, and therefore, he should go for the perfect matching strategy in that case. But here what we have observed that we have not taken into account the yield basically. So, therefore, in this context if you want to talk about the yield, we have certain techniques. We have the immunization strategy. Basically, they decide the optimal strategy to immunize the portfolio from interest rate changes, and the immunization technique basically attempts to derive a specified rate of return during given investment horizon regardless of what happens to the market interest rates. So, immunization strategy how it works? It basically works on the basis of the two ways, because the offsetting the price risk with the reinvestment risk. That means, if you know the interest rate gone off, the value of the bond goes down, but the reinvestment opportunity will be more, the return from the reinvestment of the coupons will be higher. That is why we should take the position in such a way that the price risk and the reinvestment risk should be perfectly offset to each other. So, that is the concept works in the immunization strategy, and we have the classical immunization. It is basically requires this frequent rebalancing, because the modified duration of the portfolio always should be the equal to the remaining time horizon in the case of the except in the case of the zero coupon bonds. We have certain conditions for immunization. What is the conditions? The present value of the liabilities should be equal to the present value of the assets, and the duration of assets should be equal to the duration of liabilities. Convexity of assets in the portfolio should be greater than the convexity of liabilities. These are the three conditions always we should take into account whenever the immunization strategy works. And if you see the characteristics of the duration, it basically declines more slowly than term to maturity, assuming no change in the market interest rate. Duration changes with the change in market interest rates. There is not always parallel shift of the yield curve. Bonds with a specific duration may not be available at an acceptable price. And we have a horizon matching, where the combination of catch matching, dedication, immunization will be worked out, and it is important decision in the length of the horizon period of the investor. So, this is the way the immunization strategy works, but how exactly the immunization strategy works, and what the basic theme of the immunization strategy, and how basically this immunization strategy is very much helpful for managing the risk in the financial market in the bond investment. And also there are other techniques of active portfolio management strategy, which will be used in the bond case to get the to maximize the return in the market. So, that we will be discussing in the next class. Thank you.